This is the Financially Simple Podcast, the show dedicated to destroying the complexities of money for today's small business owner. The content in the show is for informational purposes only. This show is not investment advice. Instead, seek help from a competent financial advisor or conduct your own due diligence. Justin Goodbread, CFP, is an investment advisor representative of Heritage Investors, a registered investment advisor only conducting business in states where it is properly registered or is excluded or exempted from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Here's your host, pizza-loving, certified financial planner, Justin Goodbread.
And welcome to Season 2 of the Financially Simple Podcast. In this season, we are going to dig into personal finances for us business owners. That's right. We're going to deal with personal investing, debt reduction, tax strategies, and a ton of other topics. I'm excited about it. I actually get to be a CFP this series, so I'm excited about this. Look, we're covering tips and tricks to make your personal finances as sound as your business finances. Cause I know all of us business owners, we focus on our business, and sometimes, the cobbler's kid's shoes are never shod. Sometimes our personal finances go haywire until our spouse says, dude, you didn't pay the electric bill. Power's getting shut off. Crap. Been there, done that, because I was focused on the business. So today's topic is, how should I pay myself, and how frequently should I pay myself from the business? Look, no matter if you're just getting started, if you're a seasoned business pro, the method in which we pay ourselves and the frequency should be visited very often. Now, perhaps when you just got the company started, you went through a period of time where you said, dude, I am just trying to make money. Brother, I pay myself the money that the company makes. And while this may be true in the early days, as the business matures, we should gain control of our withdrawals from the business and actually plan how much we should pay ourselves and the frequency of payments. So we're going to deal with those over the next few episodes on how we pay ourselves, the frequency, what are we going to do with it, et cetera, et cetera. Now, before we get started today, I want you to know that I'm trying to oversimplify something once again. Oftentimes when we try to simplify financial matters, it can seem to us professionals that I'm leaving out something. I can leave out a lot of details. I'm going to tell you need to visit with your CPA, your CFP, because they can give you guidance in these particular areas. So first, let's deal with the how. And we got to start with some basics. Now, depending on the structure of your business, it's going to actually dictate how you get paid. So let me explain what I'm talking about. For example, if you are structured as a C corporation, an S corporation, or even an LLC taxed as an S or a C, then you probably have filled out a W-4 form and you're actually getting a W-2 or a paycheck, and you're having withholdings taking place. The company may be matching your FICA FUTA SUTA, depending on which state you live in, but nevertheless, you're getting a paycheck. And potentially, if you own a C Corp, an S Corp, or an LLC tax as such, you may also get distribution of profits or dividends from those entities. So how you get paid, if you're an entity of an S, a C, or an LLC tax as such, then you may be getting a W-2 and potentially profits and dividends. So that's one of the ways you'll how. On the other hand, if you're a sole proprietor, or maybe a partnership or an LLC taxed as a partnership or a sole proprietor, single member, whatever, then you're going to get a K-1. Similar kind of to a W-2, except that there's no withholdings. There's no company match. You're not withholding and prepaying your taxes. Now, the advantage to a W-2, if you're in an S Corp, a C Corp, or an LLC tax as such, you're having federal, state, FICA, FUTA, Medicare, all those fun things withheld as you're getting paid throughout the year. So we'll call these payroll taxes for the sake of now. So as you're receiving a W-2, then you're having payroll taxes withheld, and the company's matching, the company's getting some tax deductions, et cetera, et cetera. But if you're not receiving a W-2, then you are having to deal with self-employment tax, which is roughly 15.3% of the first $128,400 for 2019. What does that mean? Well, we're going to get to that, but inevitably you're having to pay estimated taxes is what's going to happen. And you're having to make quarterly estimated taxes depending on how your CPA or your bookkeeper has you set up. Now that we have the basics, knowing that the entity type, the type of business we have dictates the type of pay we get, let's talk about kind of some variations there. So there's a difference between guaranteed payment and distributions. And that's some gobbledygook. It really is, some technical terms. But if you're an LLC that's not taxed as an S corporation or as a C corporation, then it's possible that you may be categorized for guaranteed payments or distributions, depending on how your company is structured. So here's kind of the detail. If you receive a regular scheduled payment and you're a member of the LLC, and you're getting paid for services rendered that is, here we go, this is the key, that is not predicated on the LLC's income. In other words, you're getting a salary, okay? Doesn't matter what the company's making, you're getting a salary. Then it's going to be treated as a guaranteed payment. Okay, now there's some exceptions, there always is, but for the most part, if your income is not predicated on the LLC's income and you're getting a salary, then it's going to be considered guaranteed payments. Here's the key, it's the not predicated on the LLC's income. On the other hand, if your compensation is a direct correlation to profits, then it could be a distribution. So distributions are generally made relative to prior or current year's earnings, or sometimes you may be liquidating a membership interest, whereas guaranteed payments are made irrespective of earnings. Man, Justin, why in the world would we want to know all that? Look, if you're an LLC, you have some flexibility on how you get paid, but you got to be careful because if you misclassify this type of payment you're going to get, then the IRS, man, trying to reclassify, it's just a pain in the butt. It's a headache to deal with. The reason why it matters is because under the new tax code, guaranteed payments are often not included as part of the QBI deduction. Okay. If you go back just a few episodes a while back, or I've talked about this a couple of times on various things on YouTube channel, et cetera, the QBI deduction is potentially a 20% deduction on the income the company makes. So if now you have a guaranteed income, and let's say that your guaranteed income is classified for $400,000 as guaranteed income, when in fact it maybe should only be 80 or 100, then you're missing out a huge potential deduction for the QBI deduction. So that's why if you're an LLC, you need to revisit whether or not it should be guaranteed income or distribution of profits. That's the first thing. The second thing is, depending on if you're a W-2, and I'm going to flip now from an LLC like to an S corporation or versus an LLC. If you're a W-2 income, then your 401k contributions and your other benefits associated with the 401k is attributed to your W-2 or your K-1 income, your net profits or your W-2. So here's where it gets kind of tricky. And we have to play with this in our S corporations to make sure that we can do this with the tax advisor's help, make sure the numbers are working for the owner's best benefit. We had a situation where we wanted to create a 401k that included profit sharing, which also had a cash balance arrangement. And we did it for minimization of taxes and to help the owner retire sooner. Well, the problem is if I ran the calculations for an LLC, all the profits of the company. So let's say this company made $1 million. So let's say the company made $100,000 or whatever the number ends up being. Whatever that number ends up being, the company is going to use those dollars to calculate the benefit for the owners. If, however, you're an S corporation, let's say, or an LLC taxed as an S or a C corporation, and you have a W-2, we're only eligible to use the W-2 income for tax reduction planning through a cash balance profit share 401k arrangement. So how you get paid is more than just, hey, I have profits from the company. It's a lot more than that when you start looking comprehensively. In the S corporation world, what we could do is we could affect the W-2 one way or the other. There's advantages and disadvantages doing so. In the LLC world, if you're using guaranteed payments versus dividend, there's advantages and disadvantages to this. So how you get paid matters. It really does. And with that, I'm going to tell you to stop what you're doing, call your tax advisor, your CPA and LLC, or your planner and say, hey, brother, look, am I paying myself the right way? What do you mean? Well, is my W-2 too high? Well, what do you mean? Those are the questions you should start asking your planners. If your CPA or your planner doesn't have a clue what you're talking about when you ask those questions, fire them. Get you a better planner. This is basic 101 tax planning, investment planning, retirement planning, driving maximum value up to yourself. That's what we're dealing with here. Okay. If your planners don't know what they're talking about, or if they've never asked you these questions, these are basic 101 financial planning for comprehensive planners. This is why I often say don't work with the investment gurus at your local TV commercial type of investment firm. They're there to sell you stuff. They don't often talk about this. This is why comprehensive planning matters so much for us business owners. All right. Now I'm off my soapbox. Sorry about that.
You're listening to the Financially Simple Podcast. Show your support by subscribing to this and our other educational business channels at financiallysimple.com.
Let's go to how often should we pay ourselves. Now, how often we should pay ourselves depends on a number of different things. One of the first things we advise our clients is to achieve a safe position. People refer to this as an emergency fund, and depending on your specific needs, your cash amount could vary. It really could. Regardless, we want your inflows of income from the company, how much you pull out of the company, to match your outflows of your specific budget, your specific personal planning goals. We don't want to pay ourselves more and we don't want to pay ourselves less. We want to match if at all possible. I happen to pay myself personally one time a month. Others pay themselves weekly, others bi-weekly. Depending on how you set up your family budget, your pay cycle should follow. I do one time a month because I'm busy working with somebody else. I want to deal with my stuff one time and forget about it. Others get paid bi-weekly. Maybe their paycheck and their pay cycle is every 2 weeks. Then what we want to do is we want to set up the budget to match. Regardless, we want to have enough cash in our accounts to float, I'm going to use that term, float, the lifestyle or the budget we have. So I'm going to give you a crazy little Justin, just fun example here for you. Have you ever picked up the back of a toilet and look into it? You know, that little reservoir there where you put your little flusher thing on the house toilet. You pick it up, you look down inside there, all the water is in there. It's the reservoir when you go to flush the toilet. All the reservoir causes gravity to make the waste go down the pipes. In the back of the toilet, in the old school, some of the new ones have a little different one, but they have a float in there. There's inevitably some type of cork. Maybe yours has like a round float around the fill shaft. Maybe you have a little black ball inside there in the back of the toilet, but there's a float nonetheless. And what that float does is when you flush the toilet, the float drops, the water goes out the toilet. As the water refills, the float shuts the water off. So you don't have water going all over your house. So that float works. Okay. Now think about that analogy. I know it's kind of silly, but it helps you think about how your account should work. You want to have enough cash reserves in there. So as you're flushing out that dollars to pay your budgets, your basis, your amount of money you have in your checking savings account never goes to zero. And if they do go to zero, friends, then you're living paycheck to paycheck, and that's awful. That like keeps you up at night. We don't want to do that. We want to have enough money to get away from that paycheck to paycheck. How do we get away from the paycheck to paycheck lifestyle? And this goes directly to how often you should pay yourself. So here we go. First thing is you set your spending amounts. We're going to talk about this in the next coming up episodes on how you set your spending amounts. We're going to talk about specifically how you create your budgets. But number one, you set your spending amounts per category. Number two, you cut any expenses that don't match that spending amount. The third thing you're going to do is you're going to build your cash in your checking account to equal your largest single monthly expense. So let me give you an example of what I mean. If your house payment is, let's say, $2,000 a month, then you need $2,000 as a checking balance in addition to your monthly bills. So here's a simple analogy for you. Depending on how you pay yourself, let's say that my bills add up to $4,000 a month. Let's just say that. And my biggest is, let's say my house is $2,000 at $4,000. Therefore, I'm going to try to get $2,000 extra above my monthly bills. So I need $6,000. $6,000. So that's all my monthly expenses plus my single largest payment. That's an easy way to calculate it. Let's do it a different way. Let's say that your monthly bills add $3,000 and your single largest payment is your rent, and it's $1,000 and you need $4,000 into your checking account. That's the starting point. Then we're going to take the income, the surplus from our income, whatever that may be, and we're going to move into a savings account outside our control. I actually told a client this last night. I told a client, I said, look, you got some extra money. I want you to get in your car tomorrow and drive across your town. Go a city away, find a local bank or a local credit union that you don't know anybody that works there. Open up a checking account or open up a savings account and deposit the money. No, you do not want an ATM card. No, you do not want electronic access. No, you don't want to have online banking. No. You want to make it where if you need that money, you got to do exactly the same pain in the butt thing you just did. Get in your car, drive across town, get the money out. She's like, I'll never do it. I said, that's the idea. But you know it's there. You want to start setting up your surplus in a savings or checking account outside of your control. You don't want it linked to your regular everyday checking account. You don't want that. This is how you're going to get away from the paycheck to paycheck lifestyle. The fifth thing you're going to do is once you've reached your savings target, then you're going to build your checking to the same target. So let's say your goal is to have $10,000 in savings. Ultimately, you're going to go back and you're going to build your $10,000 into your checking account. And at that point, friends, you now have your emergency fund. Congratulations. You've moved yourself from paycheck to paycheck. And then you can affect how often you're going to pay yourself. If your budget dictates that you need to pay yourself weekly, then do so. Doesn't matter. You're just trying to keep the float. You're trying to keep the water filled to the right level in the back of that reservoir, as we talked about with that toilet. You're trying to keep that cash account to where it's kind of just barely moving up and down versus bouncing up and down like a basketball. We just don't want that. We want it to be just nice and easy. Okay? Nice and easy. Look, you say, Justin, I need some help. Hey, check out the new debt course. Many business owners getting eat up with debt. We got a debt course on Financially Simple. This is the exact same method, by the way, that I use to eliminate 6 figures of debt in my life. This works. It's the same things I teach clients. It's got a custom spreadsheet in there. It's got me teaching on the various debts, why you might want to pay one off of the others. We're going to talk about those things like a debt avalanche, a debt snowball, all those things. Take a look at it. It's reasonably priced. It's not too expensive. And if you purchase it and you like it, let me know why. If you don't like it, you say, hey, Justin, I felt like it was a total waste of money. If you do this, man, I'm listening. This is the first course we ever put out, and I want it to be beneficial. I think it's beneficial. Like I said, it's what I used in my life. Tell me what your feedback is on that. And with that, friends, I'm signing off on this episode. I promise I'm going to try to get these things shorter, under 20 minutes in length. So I'm going to shut up and say life is hard. It is. Life is good and life can be frustrating. Money doesn't have to be. Let's continue to make our lives at least financially simple. We'll see you next time.
You've been listening to the Financially Simple podcast. For more business and personal financial help and information, head over to financiallysimple.com today.